All right, so that was kind of entity choice. Now you've kind of got the vessel. Now let's figure out how to transition from old co to new co. So we're talking about the conversion mechanics. Generally speaking, there's three ways of becoming employee-owned. One is to restructure old co. I'm just going to use old co and new co as references to for purposes of describing these three options. One option, not up here, is to just restructure old co. Let's say you've got a single member LLC and that single owner wants to become employee-owned, has 5 owners. That LLC could just adopt an operating agreement and admit 4 additional members and become employee-owned. No need to change the structure. Single member that admits members automatically becomes a multi-member LLC that defaults to a partnership. So you could just default to a partnership, or you could elect some other tax structure, but old co stays the same. The other two involve forming new co, and then you have to figure out how to get old co into new co. There's 2 ways to do that, driven by tax. One is an asset sale, the other is a stock sale. The asset sale is what it sounds. It's a way to get the underlying assets and or liabilities of old co into new co through an asset purchase agreement. The other is to sell the stock, the ownership, the paper representing the ownership of old co, and transfer that to new co. New co essentially just owns the paper of old co. Everything else involving old co stays the same. There are differences in how those two approaches are taxed. This is about the part of the conversation we tell folks, talk to your accountant. In fact, we'll tell people to talk to the CPA before coming back to us to start drafting a single word, because this will largely be driven by tax with some input and involvement from the lawyers around kind of relatively ancillary matters. So the CPA will usually be able to construct, and I don't mean to put you on the spot or create more work, but usually CPAs can look at the net of buyer and seller and tax treatment on capital gains and income tax and say, on the whole, this transaction is best served by an asset sale.
Question, has this conversation been changed any by the opportunity zones that was taxed in the Tax Act of '87?
I believe it will. The rules are still pending, and my understanding is that the opportunity zone regs, there are rule changes proposed that would make it more favorable to invest qualified property into cooperatives or worker cooperatives, but I think it's too soon to know for sure. So it's an opportunity, but too soon to know. One of the reasons why this asset versus stock sale is important is because buyers, and this actually comes from the world of private equity, buyers will pay more to buy the assets of a business because they can immediately start depreciating those assets. You can't depreciate paper. The IRS says if you just buy stock, you can't depreciate it. Paper doesn't degrade, but apparently assets do. The considerations down below involve the attorneys. And again, we talked about the example when there's a business that has long-term contracts, licenses, bank accounts, leases. Those can be really challenging and cumbersome to assign, to actually sign those over and get consent to move those from old co to new co. And the way to avoid doing that is to consider a stock sale. Then you don't actually have to go contract by contract and assign them. You will sometimes have to provide notice, but you won't have to actually get consent. So that's usually where the lawyer might push back and say, or the client might push back and say, I refuse to go ask for consent from the landlord and my bank and all these other things, because the minute the bank has to look at an employee-owned structure, they're going to not know what box to check, and then it becomes a little more cumbersome. The other is state law considerations. In some states, like New York, you can't actually convert one entity type into another. You can't actually tell the Secretary of State, we're an LLC now, but we want to become a cooperative. We want to file articles of conversion. You can't do that in New York. I think there are 22 states in which that's the case. There's about 27 states or so that allow for something called a statutory conversion. Washington is one of them. Colorado is one of them. In one fell swoop, in one document, you file what's known as articles of conversion, and you go from old co to new co automatically. Automatically. The LLC becomes the co-op. The co-op is, and everything seamlessly just becomes the new co. But for tax purposes, a statutory conversion is a stock sale. And again, the CPA might not like that. So this is usually between items 1 and 2 and 3 and 4, there's usually some discussion with the CPA to figure out which one is optimal.
What was the stepped-up basis one?
That's where the buyer gets to take depreciation on the sale price. So if the capital, if the assets are only worth, they've been depreciated and they're actually only worth, let's say $200,000, but the buyer pays $1 million, the buyer gets what's known as stepped-up basis and can depreciate assets starting at $1 million. For just doing the asset sale, they get a step up of $800,000 in their basis for tax depreciation. So we've talked about 338H10 a little. I tell business owners and other folks, just write this down and bring this to the CPA. This is kind of the golden third way. You can do, basically for legal and contractual purposes, you can get the simplicity of a stock sale, but you get the tax benefits of an asset sale. There are certain requirements. The acquired company has to be an S-corp. The buying company has to be a corporation. And by that, I mean it has to be an entity taxed as a corporation. It can be an LLC, but it has to be taxed as a corporation. And 80% or more of the stock must be purchased in the first year. That's not always possible. If you're only doing a 30% sale, 338H10 might not be possible. But we just did this on a $2 million deal, and it was phenomenally, it solved a lot of problems. The client basically needed the stock sale, but the accountant said, this is going to be really bad for the buyers without stepped-up basis. And so this is basically what we came up with to solve that problem. And it's totally legal, and private equity funds have been doing this for decades. Your favorite?
Ah, yes, my favorite. Internal Revenue Code, Section 1042 is a particular section of the code that deals with co-ops. How many here are familiar with 1042? A few? Okay, good. 1042 is a method that the IRS has devised that allows an owner of a company to sell their company to either a worker co-op or to an ESOP and defer capital gains on the sale of their business almost indefinitely, in some cases indefinitely. You first have to convert to a corporation. So if you're an LLC, you would have to convert first to a corporation. It's all usually done on the same day as the sale occurs. And then you sell your entity, your business, to the worker co-op or to the ESOP. I'll use a worker co-op in the rest of the example because I'm more familiar with that process. At least 30% of the sale of your entity, of your interest, I'm talking me, I'm an owner now, I'm going to sell to a bunch of employees, I'm going to sell to a worker co-op, at least 30% of my ownership interest has to be made that first year. After that, it can be spread out over a period of time. I had one client that sold 30% the first year and then took just 10% a year for the next 7 years. It took another 7 years to sell the rest of the company. You can also do it all in one lump sum, or anything in between 30% and 100%.
And can that 30% be financed?
And the 30% can be financed by the owner. When the owner sells their 30% or 100% to the worker co-op, the proceeds that they get from the sale, say it's $100,000, no, say it's $500,000 from the proceeds of the sale. They have to take that $500,000 and invest it in what it's called qualified replacement property. And that goes to your question about whether opportunity zones, which they've just created recently, qualify as qualified replacement property. That, I don't think the rules have been devised yet for that. My understanding currently is qualified replacement property is limited to securities that are issued by active domestic corporations. IBM, Apple, your local corporation. It cannot be invested in another entity that I own, that I as an owner own. In other words, if I've got a 50% or 51% controlling interest in another entity, I can't invest that money in that. It has to be something separate from me. Okay? Then you have to hold those stocks, that qualified replacement property, for at least 3 years. After that, you can sell that that stock, and you would have to pay capital gains. Now, capital gains on $500,000 is about, just for the federal side, is about $100,000 in taxes. So to defer those capital gains and not having to pay those capital gains is a nice idea. What happens is, after that 3 years, you can either piecemeal sell that stock, that qualified replacement property, or you can hold on to it until the day you die, in which case there's a step up in basis and there's no capital gains. Your heirs pay no capital gains on the sale of the proceeds of the sale of your business.
That's quite an incentive.
It's quite an incentive. So if you've got an owner that's elderly and would like to sell to their employees, and they've got 20 years expectations to live, could they hold on to some qualified replacement stock for 20 years or 10 years or whatever? Or in Jason's case, he had an owner that died 2 years after the conversion. So this method would allow a step up in basis and no capital gains tax, saving $100,000 for the heirs of the business. Okay? Questions? Yes, sir.
You said you can't reinvest it in something that you own,
Yes.
but if you own stock in a domestic corporation, then you own that.
Controlling interest.
Kind of controlling.
Controlling interest. Yes.
So you could reinvest it, like you just, I think I caught what you just said, was that they sold it and then they could reinvest a certain amount of what they just did to hold that stock in what they sold to the worker cooperative.
I missed that.
And on the last slide, when you were explaining the deferral, were you saying that if they sold to a worker cooperative, then they could take,
The money that they get from the sale
yeah,
of their interest, and they invest it in something else. They can't put it into the co-op.
that was what I was checking.
Yeah. Can't go into the co-op.
And I believe you also cannot invest in a business or real estate or something that's owned by a family member. It's you, and I think it's also close family members.
Yeah, so you can't have your brother set up a business and invest in your brother's business. Okay. Subchapter T. How many of you are familiar with Subchapter T? Oh, good. Then I don't have to do a whole lot on this slide. Subchapter T, for those that are not familiar with it, the Internal Revenue Code, they like to split things up into chapters. So Subchapter S, for example, is for S corporations. You've got a partnership taxation corporation of the Internal Revenue Code, and Subchapter T is for cooperative corporations. There's a separate section of the Internal Revenue Code for agricultural co-ops called Section 521. But Subchapter T is for your standard cooperative corporation, and which would include worker co-ops. And basically, taxable income, income comes into the co-op. The co-op generates revenue through its workers. It does its operational business. End of the year, the co-op makes $100,000 in profits. Now, this is net. This is after expenses, after dividends have been paid to any investors, after the co-op decides that they need capital next year, so they've set aside, $10,000 for retained earnings, they want to buy some new equipment next year. It's the net, and that money is distributed to the members based on their patronage of the co-op. Is everyone familiar with the word patronage? Yes? I'm seeing nods. Okay, good. So we won't go into patronage. And those patronage dividends are allocated to the members usually on an annual basis, although I've seen a few that do it on a quarterly basis. But on an annual basis, the co-op is required to file a 1099 PATR with the IRS, reporting that income. And the members pay the tax on that income. The co-op, it's a deduction at the co-op level, so there's no tax at the co-op level for that income. Now, there is some income that the co-op is taxed at. It's called non-member income. So, for example, the co-op buys a building and rents it out to a lot of non-member tenants, and it's income coming into the co-op. It's non-member-based income to the co-op, and that would be taxable at the co-op level at corporate tax rates.
And for worker cooperatives, non-owner workers, that work, that labor has to be computed. That's non-member patronage. The co-op can't deduct that. That has to get taxed and go to the indivisible reserves. So it's only member patronage that can flow through.
Right, so if you've got 20 employees and 5 of them are owners and the other 15 are not, that's what he's talking about.
In a consumer cooperative situation where you've got customers that aren't members, are they doing the same thing?
No, consumer co-op, there's a specific part of Subchapter T that exempts consumer co-ops from that.
There's one comment I want to make on 1099 PATRs. The IRS has a fairly vague policy in how they treat 1099 PATRs. First, worker co-ops with W-2 earners, they have to be paid market rate salary and wages. You can't reduce those wages and try to divert that to 1099 income. You have to pay market rate wages. So provided you do, then the patronage dividend on a 1099 PATR is subject to only ordinary income tax. Now, the IRS willy-nilly sends out notices telling you that you've underreported and attempts to attach self-employment tax, 7.65. Actually, it's both sides. It's employer and employee side of. So it's about 13%, 14% above that for self-employment tax. If you're a single member LLC and you earn income, all of that is subject to self-employment tax. It's an additional 14%. If you write a letter to the IRS and say, no, you're wrong, and there's some guidance memos that I'm sure Northwest Co-op Development Center has on file or we can help share with people. If you fight back, the IRS will capitulate. But the 1099 PATR actually has favorable tax treatment for earned income because it's only subject to ordinary income tax. And the IRS refuses to take a firm policy on this, but this happened to me personally. They tried to claim an additional $4,000 in taxes or something, and I wrote back, and we were successful. They'll capitulate. They won't even have an attorney look at it. It's usually just the clerk who looks at the documentation and says, okay, you're right. But just be aware of that. And if you're counseling co-ops, I think it's incumbent on the whole development community to educate co-ops and their workers that for ordinary patronage dividends, meaning not a dividend that you get because you're on the board or because you're on a governance committee, just ordinary patronage dividends should not be subject to self-employment tax. And the IRS just changed the co-op tax reporting form, the 1120. They changed the personal income tax form. So when you report 1099 PATR, it's now really confusing where that goes. And they've basically forced you to put it under self-employment income. So we've been telling people, and Bruce Mayer has circulated guidance through the US Federation, talk to Northwest Co-op Development Center. They'll put you in touch with a CPA who can advise generally about how to do this correctly to avoid this self-employment issue.
Is there ever a situation where a member is actually another entity?
Oh, yes, you can have members that are not natural persons, yes.
Yeah, so like in that leasing situation, you had a building, then those organizations that are leasing from you could be
members, yes. It could be another whole class of membership.
Could they be eligible for patronage?
Yes.
So in multi-stakeholder co-ops, even if you've got a worker-owner class, you might have a separate class that's, say, institutional buyers, universities, nonprofits.
A grocery co-op, where you've got employees as members and maybe you've got some of the farms that are set up as LLCs and other kinds of entities as members of the co-op as well. We have talked about some of this. What I like about Subchapter T, and I'm not sure, because I think, you're an accountant? Yes?
He was an accountant.
No. We had accountants in the room, and I was able to explain it a little better, but I love Subchapter T because it's a cash flow system that the board of directors can use to help ease cash flow situations at the end of the year. I'm going to go back to my $100,000 in profits, and you've got to distribute that $100,000 to the members to be eligible to get a deduction at the co-op level and not have to pay taxes. Now, if the co-op is cash strapped and they don't have $100,000 to give to their members at the end of the year, the IRS allows them to allocate that $100,000, say it's 10 members, $10,000 each, on the books and records of the co-op. But they have to give the members 20%, so $2,000 of the $10,000 has to go to the members. The other $8,000 is just a paper allocation on the books and records of the co-op. Now, the member, the employee owner, gets a 1099 PATR saying that they received $10,000, and they have to pay tax on that $10,000. But in time, that money that's sitting in their equity account on the books and records of the co-op is redeemed and paid to the members, and it's tax-free because tax has already been paid.
It's kind of like an IRA. It's after-tax money, and it sits on the equity account of the co-op. Some co-ops are applying cost of living adjustments to that. Since the tax has been paid, it's sitting there, it doesn't earn interest. Some folks are applying, say, a 2-3% bump on that internal capital account entry so that it grows with inflation. But it's kind of like an IRA since the tax has already been paid.
Would you pay tax on that increase then in that year, or if they're increasing the equity on the books?
Probably.
Okay.
It might even be considered, well, it might be considered cap gains. I don't actually know the answer. It might be cap gains that's not paid until that money's redeemed to you. I don't know.
And we haven't gone into equity redemption, but these equity accounts can build up over time. And at some point, the employee is going to retire, they're going to leave, they may become disabled, and we'll go into that in a little bit. But that's a situation where, say you've got 5 employees, you've got 50 employees, and 5 of them all leave at the same time, and they all have $50,000 in their equity accounts. That's going to be a cash-strapped situation for almost any company. So there are methods that you can take to ease the cash strain on the company, and we'll talk about that.